The U.S. market is currently closed. As of the market close on Monday, October 20, 2025, Apple Inc., ticker symbol AAPL, closed at $262.24. This was a massive move, a gain of $9.95 or 3.94% in a single session on exceptionally heavy volume of over 90 million shares. Now, a 4% jump on a nearly $4 trillion company doesn't just happen. It's not a flicker, it's a statement. And the immediate reaction is to loop this in with the broader tech rally, to just assume it's moving with the Nasdaq or tracking the sentiment around Nvidia stock. But that's the surface-level expectation, and it's wrong. What we just witnessed wasn't a passive drift. It was a violent, high-volume repricing based on one specific piece of data that shattered the prevailing narrative about Apple's core business. The reality that hit the market was a report from Counterpoint Research. It showed that early sales of the new iPhone 17 lineup in its first 10 days are tracking a staggering 14% higher than the iPhone 16 cycle in the critical markets of the United States and China. This is the insight that changes the entire story. The market consensus was that the iPhone was a saturated product, that Chinese competition was finally eating Apple's lunch, and that consumers, squeezed by inflation, would skip this upgrade. That expectation just collided with a very different reality. Let's establish the common ground, the story everyone believed just a few weeks ago. The narrative surrounding Apple stock was one of caution. You had investors, both retail traders doing self-investing and large institutions, looking at the stock near its highs and feeling nervous. They saw the incredible run of Nvidia stock and the speculative buzz around names like Tesla stock and thought Apple looked, by comparison, a little tired. The concern was that its growth was primarily coming from price hikes and the services division, while the golden goose, the iPhone, was topping out. Competition in China from domestic brands was intensifying. Macroeconomic headwinds were supposed to curb consumer appetite for premium electronics. People doing online investing were being told to wait for a pullback, that the valuation was stretched for a company facing maturity in its key product line. This was the expectation. A magnificent, dominant company, but one whose best growth days were probably in the past. Then, Monday's reality check. That 14% sales figure isn't just a small beat, it's a blowout. It suggests that the upgrade cycle, which looked weak for the iPhone 16, is back with a vengeance. And why? Because this time, the upgrades weren't just incremental. The market seems to have underestimated the pull of the new hardware. We're hearing that the new 18-megapixel selfie camera, which Apple included in all models, not just the Pro, is a significant draw. Likewise, the Pro models, with their 48-megapixel sensors across all three rear cameras and a new 8x optical zoom, are apparently compelling enough to drive upgrades even at premium prices. This single data point from Counterpoint flips the script entirely. It says the ecosystem is stickier and the consumer's desire for Apple's best hardware is far more resilient than analysts had modeled. This is why the stock didn't just edge up, it gapped up and held those gains, closing near the session high of $264.38, a new all-time record. This move propelled Apple back past Microsoft to become the second most valuable company in the world, once again nipping at the heels of Nvidia. This is the kind of decisive move that gets the attention of everyone, from a SoFi Invest user looking at SoFi stocks and SoFi ETFs to a high net worth individual with a sophisticated Fidelity wealth management plan. The trading volume of 90.5 million shares is what's truly telling. The average volume has been closer to 40 or 50 million shares. This wasn't passive index buying through Fidelity ETFs. This was active, high-conviction buying. This was institutional money waking up and realizing their underweight position was a mistake. We saw analysts at Evercore ISI immediately react, adding Apple to their tactical outperform list and jacking their price target to $290. They see this as a powerful setup heading into the company's earnings report, which is scheduled for October 30th. Their team even suggested a specific options trade, buying the December 260 calls, signaling they believe this move has legs. This is the kind of sophisticated play that traders on the Interactive Brokers platform live for, using the Interactive Brokers trading platform to get precise execution on options. It's a far cry from just buying a few Robinhood fractional shares on the Robinhood app, though those investors are certainly celebrating too. Looking at the institutional movements just before this spike is fascinating. Recent 13F filings from mid-October show some very smart money was already getting positioned. Vontobel Holding, a major Swiss asset manager, reported increasing its stake by over 17%, adding nearly 1.8 million shares. Hilltop Wealth Advisors reported a massive 187% increase in their position. While some smaller firms trimmed, the big money, the kind that moves markets, was sensing that the pessimism was overdone. They were placing their bets while the consensus was still looking the other way. This isn't just about online investing, it's about deep analysis that contradicts the noise. The noise was China competition. The reality was the new camera is a must-have. Now, let's step back for a moment and look at the company itself, for those who might be new to this investment. Apple's business is famously split into two parts: products and services. Products are the hardware everyone knows: the iPhone, Mac, iPad, and the wearables, home, and accessories category, which includes the high-margin Apple Watch and AirPods. This is the engine that builds the ecosystem. But the real jewel for many analysts is the services division. This is the high-margin recurring revenue from the App Store, Apple Music, iCloud, Apple TV+, and advertising. The common belief was that services would be the primary growth driver. The iPhone 17 sales data suggests that the hardware division is far from finished and can still deliver massive upside surprises. This creates a powerful two-engine growth story. When hardware sales boom, it pulls millions of new users or upgrading users deeper into that services ecosystem, feeding the recurring revenue stream for years to come. It's the ultimate flywheel. This recent surge has of course put the stock in new territory. It's breaking out. For investors managing their own portfolios, maybe through an individual brokerage account at Fidelity or using a SoFi robo-advisor, the question is, what happens next? The entire market is now laser-focused on one date, Thursday, October 30th, when Apple reports its fiscal fourth quarter earnings after the bell. The consensus estimate is for earnings per share around $1.74 on revenue of about $101.7 billion. But those numbers may now be irrelevant. The iPhone 17 was launched just before the end of the quarter, so these strong sales figures will be the headline. The market will be listening not just for the Q4 numbers, but for the guidance for the critical December holiday quarter. Given the Counterpoint data, expectations for that guidance have just been massively reset to the upside. This brings us to the new tension, the next expectation versus reality setup. The new expectation is that demand is incredible. The new reality, however, is a potential supply-side crisis. Reports are now surfacing, particularly from India, that retailers are experiencing severe stock shortages of the iPhone 17, especially the Pro models, right before the peak Diwali shopping season. Retailers are reportedly furious, blaming Apple's distribution strategy. This is actually a good problem to have. It confirms that demand is red hot, so hot that Apple's world-class supply chain can't keep up. The risk is, can they ramp production, particularly the made-in-India Pro models, fast enough to meet this demand? Or will they leave sales on the table during their most important quarter? This is the new narrative. We've moved from "will anyone buy it" to "can they build them fast enough?" So, what's the future outlook here? The bull case is clear. The iPhone 17 is a hit, the upgrade cycle is strong, and this will drive a cascade of revenue and profit growth. It will feed the services business, and the stock will follow Evercore's 290 target and beyond as analysts scramble to update their models. This makes the stock a core holding for anyone serious about investment sites or investment help. It's the anchor of countless Fidelity IRAs and Fidelity mutual funds. The bear case is no longer about demand. The bear case is about execution. Can Apple navigate the supply chain crunch? And, looking longer term, can they finally deliver on their Apple Intelligence promises to create another growth vector beyond the hardware refresh cycle? Many see features like the new center stage camera as the first simple